Today on Retiring Well with Centennial Wealth Advisory. Is your portfolio truly diversified? What does it mean to be diversified?
Diversification, it's simply putting different eggs in different baskets. How hard could this possibly be? Well, as you're going to find out today, this is one of the biggest misunderstandings, the biggest areas that people just like you get into trouble with their planning.
Coming up, we'll analyze a real portfolio holding many positions which turned out to be not diversified at all when it mattered most.
These people have 30,000 positions in 20 different mutual funds. We think they're diversified, but at the end of the day, we look at their portfolio, you know what? They could hold the Vanguard S&P 500 and have the exact same outcome. The exact same outcome.
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese. I'm excited about this week's show. This week, we are talking about diversification. I know, it's simple, right? Diversification. It's simply putting different eggs in different baskets. How hard could this possibly be? Well, as you're going to find out today, this is one of the biggest misunderstandings, the biggest areas that people just like you get into trouble with their planning because you think you're diversified, and at the end of the day, you're not. That's what we're talking about. Make sure you pay attention to today. Now, before I jump into that topic, what do I want to do? Same thing I do every week. I want to take a moment and share with you why we do this show. You see, I believe your best is yet to come. I believe the second half of your life is going to be fantastic. That's a time of your life where you pursue, the things that, provide meaning in life. That provide significance, whether it's spending time with family or traveling or doing whatever you want, volunteering, doing whatever you want to do. The point, though, is this. Whatever activity it is that provides significance in your life, that provides meaning, guess what? It usually costs money in some way, shape, or form. And you've got to make good choices. You got to make smart choices about your money. The entire financial media, it seems like all they want to do is tell you, hey, here's how we grow money. Here's how we grow, the stock you should buy today. Use those retirement plans, whatever it is, but here's how you grow money. What don't they talk about? They don't talk about what happens once you've reached the stage of financial independence, once you've won the game. Once you've won the game, how do you protect those winnings? How do you stay winning? How do you make sure your money lasts as long as you do? How do you make sure that your money supports the activities that you want to do? That's what this show's all about. So this week, we're talking about diversification and really effective diversification. So let me ask you this question. Is diversification good? Is it good or is it bad? Well, this is something I think we can all agree on. We all know, I'll bet you're sitting there, I bet immediately when I ask that question, I will bet that immediately in your head you said, well, it's good, of course. I'm sure that's how you answered me. Okay, let me ask you another question. Why is it good? What does diversification do for you? What does it do for you? Again, I've asked that question to, I think at this point, thousands of people. And it's amazing. They all answer pretty much the same way. Say, well, diversification is good because it helps me, helps you, to avoid losing a bunch of money when markets are bad. The idea is that if you are truly diversified, if markets are bad, let's say markets are down 40%, you're not down that much. You're not down 40. You might be down 10 or 20 instead of 40 because you've got only some of your money there. Some of your money's over here where maybe it's making money or at least not losing. This is what I hear all the time. So I would ask you this question. If the markets are down 40 or 50% and you're down 40 or 50%, are you diversified? Well, I think we know the answer to that. If the markets are down 40 and you're down 40, guess what? You're not diversified no matter how many funds you hold. I mean, it's as simple as that, and I think it's something that we can all agree on. Now, here is where the rubber hits the road. This is where the problem comes into play. All the time, we come across people just like you. They come to our office. They take advantage of that retirement roadmap offer that you'll see on this show. They come to the office, and what happens is we analyze their portfolios, and they think they're diversified, but they're not. And the reason goes back to how I invested my parents' money back when my dad first retired. And that's a story I'll share with you right after the break. Don't go anywhere. All right, folks, I want you to pay attention to me right now. I have a very special offer. If you're one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, July 6th or Thursday, July 7th at Cafe Blue in the Hill Country Galleria, Tuesday, July 19th or Thursday, July 21st at Gumbo's North in Georgetown. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. This week we're talking about diversification, and are you truly diversified? Or are you like most people? You think you're diversified and you're really not. Well, I told you at the end of the last segment that, this all for me started back when my dad retired. So I just want to share this story with you because it's a good example of thinking you're diversified when you're not. So, I hate telling this story because it's basically a story of me not doing a great job for my parents back when they retired. So I obviously don't like to share it because, it's never a good thing for one's ego to talk about your failures. But I need to because this will help you avoid the failure that I have my parents. So when my dad retired January 1, 2000. Now, he worked for State Farm for 32 years as a claims adjuster, and that meant that, if you got in a car accident or something happened to your house, he was the guy that would come out, look at your car, look at your house, and tell you what you would get from the insurance company based on whatever your policy said. That was his job. So anyway, after 32 years, at the age of 63, I want to say, when he retired, it was January 1, 2000, he retired. Now, when he retired, he had Social Security and a pension. Those two income streams, and by the way, my parents are still alive today, those two income streams, they handle all of their basic needs. So they're good there. But he also had a 401k. And the idea that he had was his 401k, the income from that 401k, would take care of the extras. The traveling they wanted to do, buying a car every now and then, that kind of stuff. So my dad retires January 1, 2000. He came to me and said, Mike, here's what I want you to do. Now, listen to what my dad told me here. This is key. Think about yourself when you hear this. My dad came to me, I'm 5 years in the business. I'm a hotshot financial advisor, at least I think I am. And he said this to me. He said, Mike, here's what I want you to do. Here's my 401k. Here's what I want. Number one, protect my principal. Number two, give me some income. This is going to be my fun money. Give me some income, regular income. And number three, if you can, grow it a little bit. Now think about that. Isn't that exactly what you want? Protect your principal. Take some income. And if possible, grow it a little bit. Well, this was 2000. It's a new century. We've got this problem licked in the financial industry. So what I did is I was working at the time for a big brokerage house, and I did what they told me to do. They said, here, let's put together a balanced portfolio. We'll do some stocks, we'll do some bonds, we'll do some real estate and some commodities. There'll be U.S. positions, there'll be international positions. I had everything in that portfolio. I thought it was wildly diversified. I even took it to my manager and said, hey, this is for my parents. I want to make extra sure I'm doing the right job. Would you make any changes to this? And I remember my manager looking at that portfolio and telling me, Mike, this is perfect. This is perfect. So we took his 401k and invested the money and started paying him some income. I don't know if you remember 2000, 2001, 2002, but that was the dot-com crash, 9/11, all that kind of stuff. And 3 years into my parents' retirement, 3 years into retirement, fully half of the money that my dad spent 32 years saving, 32 years accumulating, fully half of that money was gone in 3 years. I remember sitting at the kitchen table with him and my mom and sharing that information and telling my mother that she would have to reduce the income by half for the rest of her life. What is the moral of this story? I had built a portfolio based on what the big Wall Street firms told me to do that I was told was perfectly diversified. I was told I did exactly the right job. Yet at the end of the day, I could have put my parents' money in the stock market, just one S&P 500 fund, and gotten the same result. We thought we were diversified. We weren't. Now don't go anywhere, because after the break, I'm going to share with you how that exact same story is still happening every day to people just like you. All right, folks, I want you to pay attention to me right now. I have a very special offer. If you are one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Wednesday, July 6th or Thursday, July 7th at Cafe Blue in the Hill Country Galleria, Tuesday, July 19th or Thursday, July 21st at Gumbo's North in Georgetown. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. We're talking about diversification this week. Are you truly diversified, or do you just think you're diversified and you're really not? In our last segment, I shared the story of my parents and how when my parents retired, I put together what I thought was a very diversified portfolio. And at the end of the day, it turned out I could have put their money in the S&P 500. I would have gotten the exact same outcome. And then I said I asked the question, what about you? Are you truly diversified? Or are you just like my parents, where we all thought you're diversified, but you're not? You know, I want to share this little story with you about a couple that came to the office. So they're watching the TV show just like you are right now, and they thought to themselves, you know, I'm going to call these guys and I want to have them analyze my portfolio. I want to see where I'm at. And I'm going to call them John and Jane Smith because, as you know, in our industry, it's all about privacy. We don't share names. But these are real people, real people. So they came into the office and they shared their portfolio with us. And you know, I'm looking at it here. It's got, and we'll put it up on the TV screen for you, but basically it's 20 different, they had 20 different funds. And if I look through this list, you know what I see? I see Vanguard, I see Power Shares, I see DFA and Schwab and Scout. They're all mutual funds. They've got large companies, they've got small companies. They've got U.S. companies and international companies. They have stocks, they've got bonds, they've got real estate, they've got different sectors. This portfolio, at first glance, is very diversified. It's very diversified. And you know what the weird thing is, I look at it and say, wow, that looks really diversified. And so we put this information in Morningstar. And by the way, I'm sharing this with you because this is not a one-time thing. This happens literally every day in our office. Every day somebody comes to us with a portfolio that looks not too dissimilar than this. And these folks had about $1 million. Now some people have more, some people have less, but that's what they had. When we ran the analysis, we get something that looks like this. And there's more numbers on here than you care to even look at. I'll just simply mention that on this, you know what we learned? Those 20 mutual funds, and no kidding, held a total of 30,000 different positions. 30,000 stocks and bonds. Yeah, I think, what does it say here? It says 13,000 stocks and 17,000 bonds. They're diversified. I mean, I think we can all agree. Yet here's the problem. Because remember at the beginning of the show, what did we talk about? Why? What does diversification do for you? Why is it good? Well, it's good because if you're diversified, if the market's down 40%, you're not down 40%. You're down something less than that. And here's what we found with this portfolio. And this is the shocking thing, but here's the thing. We see it happen every single day to people just like you. Just like you. I want you to look at this big, and the guys will bring this up on the screen for you, but look at this big graph here in the middle of the page. You see that big blue area? That's the stock market. That's the S&P 500. Basically, that's what would happen to your portfolio if all your money were in Vanguard S&P 500. See that red line? That red line right there? That's this person's portfolio. What do you notice? Those two things are basically the exact same portfolio. So these people have 30,000 positions in 20 different mutual funds. We think they're diversified, but at the end of the day, we look at their portfolio, you know what? They could hold the Vanguard S&P 500 and have the exact same outcome. The exact same outcome. Meanwhile, they're paying their advisor $10,000 a year to put them in this portfolio. Plus, they're paying mutual fund fees. Now, I want to bring your attention last, right down here, right below this chart where it's highlighted. Look at that. Worst year, 2008, they're down 40%. Guess what the market was down in 2008? Yeah, 40%. Are they diversified? Not at all. They think they are. We thought they were, but they're not. What about you? All right, folks, I want you to pay attention to me right now. I have a very special offer. If you are one of the first 10 people to call, and our number right here, 512-265-5000. If you're one of the first 10 people to call and you've saved at least $250,000 for your retirement, we will provide for you at no charge, no obligation, your own personalized retirement roadmap. In this roadmap, we help you take a look at where you stand currently with the risks that you're taking with your portfolio, the fees. What are you paying your advisors, both the fees you see and the fees you don't see? What about a retirement income stress test? Will your money last? We also run a tax analysis, a Social Security analysis. This is something you absolutely want. It tells you exactly where you stand with your retirement planning. It's absolutely free, no obligation, but you must be one of the first 10 people to call at 512-265-5000. Call now. This week in our Ask Banks section, we have got a toughie. I've got a tough question for my puppy Banks. And again, by the way, if you have a question for my puppy Banks, you can send her an email because, of course, all dogs have emails these days. Her email is banks@retiringwell.com. Let's go on to this week's question. It has to do with a Sharpe ratio. Now, if you've been watching the show, you know from time to time I'll talk about Sharpe ratios and as it pertains to volatility. But we get the question all the time of, what is a Sharpe ratio really? What is a Sharpe ratio? Why is it valuable, and what kind of information does it tell us? Well, I told you this is going to be a tough one. So I went to my puppy Banks. I said, Banks, question this week, what is a Sharpe ratio? Well, good thing. It was a hot day. She was swimming in the pool, so she was kind of cooled off. And so she was feeling pretty good about things, pretty laid back. She goes, Dad, I'll tell you all about the Sharpe ratio. So let me tell you what she told me. She said, well, first of all, you got to recognize that the Sharpe ratio, it's just some mathematical equation, but what it's really for is to help tell you how good your investment portfolio is at making returns for the risk you take. Well, of course, I'm fascinated at this point. So I said, Banks, tell me more, right? So she went on. And she said, well, here's the thing. Like, imagine you have two accounts. One account averages 6% a year, and so does the other one. They both average 6. But in the first one, if you have a really bad year, you might lose 20%. In the second one, a really bad year, you might only lose 4%. So if you're going to average 6%, do you want to be in an account where you could lose 20 or one where you could lose 4? Well, obviously, you'd want to be in the second one. So what the Sharpe ratio does, she told me, is that what it does is it tells us with a number, how good your portfolio is. So the first portfolio would have a lower number and the second would have a higher number. I thought, oh, that's interesting. So I asked her, I said, Banks, well, what happens? How do I know, what's a good number? What's a good Sharpe ratio? How do you know if you got a good one or a bad one? I mean, how do you know? She said, actually, Dad, that answer is super easy. You want your Sharpe ratio to be over 1 if at all possible. Over 1? Like 100% or something? No, that's not what it's all about. It's just you want it to be higher than 1. And as a comparison, if your portfolio looks a lot like the stock market, like a market-based portfolio, it might only be 0.3 or 0.4. What you really want is a nice diversified portfolio. If your portfolio is truly diversified, she told me, you would be north of 1. So Banks says, know your Sharpe ratio, and you want it to be more than 1. That is the key to successful investing. I thought that was great information. So again, if you've got a question for Banks, make sure you simply email her. Send her an email and say, hey, Banks, it's banks@retiringwell.com. If you have a question, just type it on in there. And if she likes your question, we will answer it on the show. All right, before I let you go this week, just a quick update on my puppy Banks. You might recall that when she was 8 weeks old, that's it, just 8 weeks old, she picked a stock for you to invest in. She picked Nike. And you might recall her thinking was she was going to chew on Nike shoes, and that way we would have to buy more Nike shoes, which would lead to increased sales, which would lead to increased stock price. And so how's that going so far? And you might recall we said we're going to measure her results against none other than Warren Buffett, the Oracle of Omaha. We want to know, does my 8-week-old puppy Banks, is she any good at picking stocks as compared to the best stock picker out there? Well, so far, it turns out she's not very good at this. Warren's up 6%, she's down 8%. Oh, my poor puppy Banks, she's feeling very bad about this right now. But I told her, I said, hey, come on, Banks, you're only 8 weeks old. Who knows, things might turn around, but we'll give you another shot at some point in the future. But don't feel bad, nobody's perfect. And hey, come on, let's be honest. Who takes stock advice from an 8-week-old puppy anyway? All right. We're having a lot of fun with that, though. So, folks, that's our show this week. I hope you enjoyed it. Have a great weekend. Take care.